Good morning, everybody. Happy Monday. We have an amazing show for everybody today. What do we have, Krystal?
Indeed, we do. Lots of interesting stories to get into this Monday morning, if I'm able to speak. So some big developments. Nancy Pelosi kind of changing her tone a little bit. About banning insider trading. Opened the door just a smidge, which, given her previous comments and total scorn for the idea, is a significant development. We'll tell you about that. We'll also tell you about some pretty eyebrow-raising comments from one Dan Crenshaw on the matter as well. You may recall Crenshaw has been one of the top performers in Congress in terms of a stock portfolio. So that guy's really on to something. If you guys want to make some money, just follow whatever Crenshaw is doing. So we'll give you those details. Also, a really stunning story that you picked up on. These healthcare workers who were changing jobs, they got a new job, new hospital, all seems normal, and better offer there, better benefits, et cetera. They said, you know, life balance, all those things were good. A judge has blocked them from changing jobs because their old employer did not want them to leave. I'm having so much trouble wrapping my head around this, so we'll give you all of those details there. Maybe you guys can make sense of it. Jen Psaki under fire for some interesting comments she made about next moves for the Democratic base and how you should be approaching things. Also, major escalation and saber rattling with regards to Ukraine. But we wanted to start with the stock market, which has experienced precipitous drops. Let's go ahead and throw this first element up there on the screen. The stock market crash is likely only beginning. So if you guys have been tracking this, significant downturns here in terms of the stock market. And listen, stock market is a graph of rich people's feelings. On the way up, it mostly benefits the rich. But when you have a significant crash on the way down, it ends up hurting everyone and can spark a recession. So that is why we are focusing on this. This particular tear sheet is pretty interesting. Effectively, what this comes down to is the fact that the Fed during the pandemic went bananas with injecting trillions of dollars into the market, backstopping stocks, backstopping debt as well. Now they are not only pulling back on those bond purchases, but they are also signaling that they are going to cut interest rates multiple times this year. And so one of the things that we've been trying to talk about here is just how much impact the Fed has, certainly on the markets, but on the broader economy. And as you watch these declines occurring in the stock market, it looks like this is directly tied to investors actually realizing the party is over, interest rate cuts are in fact coming, and so they've been fleeing in particular the most speculative assets.
And the thing that really scares me is that what Seeking Alpha points to there is that there is a record amount of margin debt and credit card debt combined with low investor cash allocation. Now the reason that matters is that whenever you have a high-priced asset and you borrow against it, something called margin, what that means is that the cash isn't realized, right? The asset itself is floating and you're borrowing cash based upon the value of the net present value of that asset. But then what happens? If the asset drops, then you're going to have to get a margin call. And they're like, hey, you know, your asset isn't worth as much anymore, so you have to pay back X amount of cash.
You're in the hole now, basically.
But now, these people don't have a lot of cash per what we know in terms of balance sheets. We have a very reduced number of personal savings. All of this matters because, as Krystal said, on the way up, the stock market may not impact a lot of you. But on the way down, whenever people have to start pulling cash, this all affects banks. It affects payrolls. This would happen during the Great Financial Crisis and more. So on the way down, this can have a significant impact on your life, your employment possibilities. Obviously, everybody's 401k, those of you who are lucky enough to have them in retirement, all of that. So it's a big problem. Let's go ahead and put the New York Times tear sheet up there on the screen. And this is what you point to. Look at the Fed Lifeline S&P 500, what they point to there. And, you know, they're very much in agreement on the same thing, which is that with the Federal Reserve change in rate policy that has been announced, a lot of people are saying that with this environment, the Fed is basically triggering and making it known that the interest rates are going to be raised over the coming years. And this is simply cleaning up a lot of the more cheapest capital that was flying around within the markets, fueling some of the most speculative assets. Krystal.
Yeah, and the issue here is that there are really no right answers. So on the one hand, you know, based on what we just said, you might say, well, the Fed needs to stop doing that. Yeah. You know, don't lift the rates then. You know, keep buying the bonds, keep backstopping the market. The problem is that those policies, which have been really unprecedented, started after the financial crash. Quantitative easing is what it's called, which is just basically injecting, it's sort of like socialism for the rich, effectively, injecting trillions of dollars into the stock market. This was amped up even further during the pandemic response. And yeah, it propped up. That's why you had these headlines that were like, the bottom has fallen out of the economy, mass unemployment, breadlines on one hand, and on the other hand, stock market reaches new highs. That's why that was happening. And so on the one hand, they were using the only tools really at their disposal. On the other hand, they have helped to fuel massive inequality, and a lot of analysts say also huge asset bubbles. Now, when huge asset bubbles pop, that is not just bad for investors and people at the top. That is a disaster all the way around. Look no further than the housing crash. That was a huge asset bubble that popped with disastrous consequences that we are still getting out from under. So these policies from the Fed help to inflate these bubbles. Now, on the one hand, it's going to be a question whether they actually have the stomach for what is likely to be a major crash, a major correction. On the other hand, if you just continue these types of policies indefinitely, you're just potentially setting up for an even larger crash down the road. So that's one piece of the puzzle. The other problem here is, of course, inflation. This is the reason why the Fed has signaled so aggressively that they may have 4 or even 5 interest rate increases over the course of this year because they are trying to get inflation under control. And the other thing that they lay out in that piece that we just had up on the screen is that it is unlikely that just cutting the interest rates, just pulling back on the bond purchases, just seeing the stock market fall is going to be sufficient to totally tame inflation, given some of these other things that are going on, the supply chain crisis and all these other issues.
Right.
So that's going to continue to push the Fed in the direction of lifting interest rates. And like I said, at this point, because they have kind of created a gigantic mess, there aren't a lot of great options for them here. That's why some analysts are very concerned that we could be in for a gigantic crash.
Yeah, and we're seeing this also in the crypto markets as well. Sorry to my fellow hodlers. Let's go ahead and put this up there on the screen. Both Bitcoin and Ethereum triggered a major sell-off alongside some of the stocks. And I think that what this points to, Krystal, is we're going to get a lot of testing of theories around the economy here. Is it purely the Fed? Is it also, do we have these asset bubbles? And we're going to have the same kind of trickle-down failure effect that we had in the financial crisis. Obviously, everybody remembers too big to fail. I mean, it's not going to repeat exactly the same way, but when you have a huge amount of cash and loans and all of that tied up in the richest people's basically bets in different assets, you have no idea how that's going to affect you and your life. The other problem with the Fed is, okay, they could raise interest rates. What's likely to happen then? They could trigger a massive recession. I mean, that's not good either. So, as you said, there's no good options here. Part of the issue, which is whenever you do that, you trigger a new recession, you're going to have mass unemployment and layoffs. You're going to have the inability of people in order to borrow cash, possibly in order to keep people on the payroll. And then what happens? You're going to have huge social unrest. On top of that, we already have a supply chain crisis. We have a massive supply crunch and stuff that's coming over here. So it would actually create the worst world where we would have more of a recession, reduced amount of demand, reduce assets too, then all of that could cascade down into like some crazy spiral. I don't even know what that would do in terms of the currency markets as well. So geopolitically, obviously, this would be a big disaster, and you can't erase the human cost. A lot of people kill themselves during recessions. It's not a joke.
No,
people die.
Right.
People don't go to the healthcare. People they don't go and seek healthcare. A lot of people died during 2008 that nobody really talks about or acknowledges. So that's the human element of this that I can't help but think about.
No,
too.
that is exactly right. I mean, one of the things that we tracked at the beginning of the pandemic when, things were extraordinarily grim economically was how a lot of the people that were most vulnerable during the pandemic crash were people who had been hit hard during the housing crisis, and they'd never recovered. So they went from potentially having their own home to being foreclosed on, and now they're in these temporary living arrangements. And then during the pandemic, loss of job, they can't even sustain, the rent for those much less expensive places. So, and then now, of course, we know the way that housing prices have spiked, making everything even that much more affordable, less affordable, whether it's with regards to buying a home, and also we've seen rent prices spike. So it's a bad situation that people are in, and you pointed to crypto. It makes sense that the most sort of speculative assets would see the biggest declines first. So, you know, crypto going up gangbusters during all of this makes sense when you have so much money injected in and people are just looking for assets that they can put their cash into. So crypto benefited massively from that. Makes sense that it would lead some of the measures in terms of declining during the early days of this crash. And I don't think that you should really be looking to maybe our business journalists for advice on what to do during these times. They don't necessarily always have the greatest guidance to offer you. We just picked out one little example of that. Jim Cramer over on CNBC, let's go ahead and throw this up on the screen. He's got some great stock picks here, Saagar. Things like Netflix and Peloton.
Yes.
Go ahead and put the next tear sheet up on the screen. Stay-at-home stocks like Netflix and Peloton have experienced massive declines. Peloton has lost like 80% of its value.
A massive amount of its value.
Recently, and by the way, their executives also sold off like $500 million in stock.
That was terrible.
Before their gigantic crash. So even Peloton execs don't think that Peloton is a good buy right now.
Peloton,
so
yeah.
You're on your own, folks. These people aren't going to help guide you through these times.
Peloton is almost certainly going to get acquired for some rock bottom price. My bet is Apple. That's what I think. Borrowing that from Scott Galloway. But that being said, yeah, the CEO has actually lost his billionaire status. Shout out to Mr. John Foley. That must be tough, going from the nine-figure club
experience.
to the eight-figure club. I feel very sorry for you and what's happening there. But look, the Netflix and Peloton stocks were obviously big pandemic stocks. You know, they performed massively well during that time. And in some ways, it was a matter of time of when the crash would come. But it became so precipitously on top of a decline in the entire tech sector, on top of a decline in the entire S&P 500. So when you have all of that come crashing down at the same time, there is a large correction. And sometimes whenever it comes to markets, given that so much of it is feelings, the feeling of pessimism itself can fuel continued downselling because so few people actually control the overall markets themselves. So what really the point of this is get ready, prepare yourself. It is certainly a possibility. And unlike whenever it goes up, it could have a big, big, big impact on your life, on all of our daily lives, in terms of businesses shutting down, people losing their jobs. I don't want to see that, but it's very unfortunate. It could be a possibility.
Yeah, it's like gains are privatized and losses are socialized.
Get ready. And then calls for a bailout. By the way, nobody's going to get bailed out right now. At least I don't think so. From the political system, I don't see how they could possibly stomach that.
I mean, the bailout would come from the Fed going back to massive quantitative easing and losing stomach for seeing a huge crash. Yeah, to the psychological aspect, there kind of was this mindset that set in of like, oh, stock market's never going down. Like it's just going to go up forever. We can't possibly lose. And when that sort of psychological bubble burst, then you start to see, I mean, the early signs of it are selling off things like crypto and these more speculative assets. And then, the margin calls help to fuel more selling. And you can see how you get into a spiral where on the way up, when the asset bubbles are being inflated, the continued increased value becomes a kind of logic in and of itself. It's like, well, the value's been going up, so the value's going to keep going up. And as long as that continues to be the case, then the bubble continues to build. Once you lose that mentality, then on the way down, it's exact opposite dynamic. When values go down, that justifies more selling, which justifies you thinking, the values are going to go down even further. So it's honestly very rational behavior, the sell-off that we've seen, given what the Fed has very strongly indicated that they're going to do. And I think they've been signaling that for a while, and investors weren't totally taking them seriously, and now they're actually starting to take them seriously.
So you take them seriously and take it seriously in your own life.
Hey guys, thanks so much for watching.
That's right. Just as a reminder, you can become a premium subscriber today. Watch the full show completely uncut, our reactions to each other's monologues. You get to listen to it. You get to ask us questions, all that good stuff. Link is right there in the description or at breakingpoints.com.
Best of all, great way to say screw you to the mainstream media.